I wanted to talk about a common tax misunderstanding when it comes to distributions from a business and how distributions are taxed. My name is Merrill Taylor. I'm a CPA. I've been working on taxes for over 20 years, helping business owners save money on taxes, especially business owners making over $500,000 or more that are paying a lot of money in taxes. We have some niche tax strategies that help them save a lot of money on taxes. And so I wanted to talk specifically about this idea of distributions and how distributions are taxed. I will often get emails from clients, or we'll be on the call and they'll say, hey, I'm going to take a distribution from my business. How much tax am I going to pay? And that frustrates me a bit because distributions are not taxable when you have, other than a C corporation. So let's talk about C corporations for a second. So if you have a C corporation and you take a distribution from the C corporation, that is taxable to you. In that instance, you do pay tax on a distribution. And the downside of the C corporation is that when a C corporation makes money, it pays tax first. And then when you take money out of the C corporation, you pay tax on that distribution. So that applies to C corporations. I maybe have less than 1% of my clients that have C corporations, and even then, they probably don't need them. Most of their clients have S corporations or partnerships or sole proprietorships. So when it comes to those three entities, S corporations, partnerships, sole proprietorships, those are called pass-through entities, which means whatever happens inside of those entities flows directly through to the personal tax return. Those entities in and of themselves do not pay tax. Another very common misunderstanding is that people think that their entities pay tax. I was on the phone with someone this last week. They said, oh, well, how much do I know, when it comes tax time, how much money should I keep in my business to pay business taxes? I said, you're an S corporation. Your business doesn't pay tax. It goes to you personally. So again, that's the difference between a C corporation and like an S corporation, partnership, sole proprietor. A C corporation pays tax itself. Distributions are taxable. S corporation does not pay tax itself, and distributions are not taxable, because as what happens is you pay tax on the income that those entities make. So let's take an example. Let's say that you have an S corporation. Let's say that that S corporation makes $100,000 during the year. And let's say for some reason you don't need to take the money. You leave all $100,000 in that S corporation. You don't need the money. You're not taking a distribution. You leave it there. What happens in that case? Well, we prepare the S corporation return. The S corporation return shows net income of $100,000. So you get a K1, which is a tax form. You get a K1 from the S corporation. It's kind of like a 1099 or a W-2. It's a tax form that you get personally that says, here is your income from your S corporation that you can report on your personal tax return. So the K1 comes, you put it on your tax return, $100,000 of income. You are taxed on the whole $100,000 of income, even though you left all of that money in the S corporation. You are still taxed on that $100,000. And then there is an accounting on that S corporation return that says, okay, this person, this shareholder, has recognized $100,000 of taxable income, but has not taken a distribution. So there's an account kind of balance on that return that says, here's how much has been taxed to that S corp owner, but has not been distributed. It's undistributed earnings. And so the next year, let's say, year one, make $100,000, you don't take anything out. Year two, let's say for some reason, the business doesn't make any money that year, but it still has that $100,000 sitting there that you can take. So let's say you take a distribution in year two. How much tax do you pay on that distribution? You pay 0 tax on that distribution because you already paid it because of the income in the prior year. So when it comes to distributions from an S corporation, partnership, sole proprietorship, you don't pay tax on the distributions you take. Those just come out to you. You only pay tax on the net income. So let's take a scenario where the business makes $100,000, your K1 shows $100,000. Let's say you took $50,000 of that out as a distribution. How much are you taxed on? You're taxed on the $100,000 of net income. That $50,000 you took as a distribution comes to you as you've already paid tax on it, then you're left $50,000. So in a future year, you can take $50,000 of that out. So that's how it works for like an S corporation, partnership, sole proprietor. You're not taxed on distributions, you're taxed on the net income. So even though and it's a common misunderstanding where people will say, hey, my business made $100,000 last year, but I only took out 20. Well, great, you're taxed on $100,000. Or my business made $100,000 last year, I took out all 100,000. Okay, great, you're taxed on 100,000 either way. So just keep that in mind. We're not worried about distributions when it comes to those. We're worried about what the net income is. We want to see the P&L, because the income statement, the profit and loss, because that's what you're going to be taxed on, not so much on the distributions. So if you want more tax updates, then make sure to go to taxtutor.com and subscribe to our weekly newsletter.